Hello, my name is Leonard Washington, and I'll be presenting a project on cost capital, capital structure, and capital budgeting on Chevron. During this presentation, I will be determining the cost of debt, the cost of preferred stock, the cost of equity, capital structure, and the weighted average cost of capital for a public traded company known as Chevron. Chevron Corporation is among the leading players of oil and gas globally. Chevron Corporation is headquartered in California in the United States, and it has operated in 180 countries across the globe. The firm is engaged in almost all the activities of oil and gas, starting from production and exploration, power generation and chemical manufacturing, transportation and marketing, sales and refining. The upstream operations involve producing, transportation, and exploring of core products such as oil and gas, while the downstream is mainly involved in crude oil refining and marketing ending products of crude oil. Other than oil and gas, the company is also involved in generation of alternative sources of energy such as wind, hydrogen fuel, biofuel, and solar, among others. The number of full-time employees at Chevron is 48,200 stationed worldwide. Chevron Corporation stocks are traded on the New York Stock Exchange as CVX. The firm registered a revenue of about 146.516 billion in year 2019. 2.924 billion was recorded in net income. This shows that it is among the largest corporation across the globe. Currently, Chevron Corporation is considering a new project to maximize shareholders' wealth and increased profits. The project initial investment is 175 million, and the project economy period is 11 years. This study aims to determine and analyze the corporation finance of Chevron Corporation with focus on the cost of capital and capital structure. Furthermore, it determines whether Chevron Corporation financial position is sound for the investment of the money for the new project. The net present value for the project is to be considered by Chevron will be 518,300. Computation of the annual depreciation and the estimation of the cash flow has been provided in Excel. Capital budgeting analysis using NPV and IRR has been provided. The daily beta for the firm is 1.0293 from the year 2015 to year 2019, whereas the risk-free rate of the same project is 2.25%. The expected market rate of return is 10%. The cost of debt is 2.23%, while cost of equity using the CAMP model is 0.23. The average of the weighted average cost of capital is 6.88. The firm degree of financial leverage is sound financial leverage. As from the structure, we can see that in 2019, Chevron financed its assets with 26.973 billion compared to 144.2.13 finance and assets with finance 0.3 from the stockholders' equity. Okay, this means that the firm can easily get additional funds from creditors as there is reliance in investors' funds. Investing in new projects is a plus for them as the return are consistent, strong, and there are increasing net income for the 11 years. Next, I will discuss the estimation of the cost of capital. The cost of capital is defined as the cost of a firm funds, which includes equity and debt. The cost of capital is a benchmark for comparing the worthiness of the investments that is made. Return on capital invested needs to be more or as the same cost of capital for a business to be attractive to investors. Both cost of debt and cost of equity must be computed to determine the cost of capital of the firm. Cost of debt of a Chevron Corporation was computed based on the interest obligations of the firm. The interest expense for Chevron in 2019, as from the income statement, is $798,000, and the total debt for the same year was $23,691,000. The cost of debt before taxes for Chevron is 7,800,000 divided by 23,691,000 multiplied by 100. As the result shown that the cost of debt before tax is 3.37. However, it is also important to calculate the cost of debt for a firm after tax, as Chevron Corporation exposed itself to tax obligations by getting finance from creditors. Cost after tax of debt is computed by multiplying the before tax cost of debt of the 1 minus tax rate. From the chart website, that the tax rate of Chevron Corporation is 33.89%. Using the data above, the cost after tax of debt equals 3.37 times 1 minus 0.3389 close parentheses equal 2.23%. The cost of equity. This is the least rate of return that stockholders expect after finding an investment. There are various methods that are used to determine the cost of equity of Chevron. These approaches require estimations of one or two components that are used with computing the cost of equity. Next, I will discuss the CAMP model. This is a model that is used to determine the required rate of return on a firm risk assets such as Chevron Corporation common stocks. Additionally, it shows the outlay risk for capital. This is a model that shows individuals the importance of having diverse sources of funds. To use the model, an individual is meant to have assets that are on capital lines by either borrowing or lending at a risk-free rate. Whereas the beta, which is calculated from the historical data, which is 1.029336. The positive beta shows that the return on stocks generally follows the market. The market risk is which is 10 minus 2.25, which give us 7.75, which is the risk-free rate, and it is given as a treasury bond yield. Therefore, the required rate of return, or the cost of equity, equals the 2.25 plus 1.293 times the 7.75, which give you 10.23%. The rate of return of Chevron Corporation is 10.23%. The market return premium is lower than the annual rate of return. This is why the firm is chosen by investors as a um, as a good investment. The cost of equity, which is 10.23, is lower than the ROIC, which means that the company investments are generally generating good returns. The DCF model is another model that we use to compute the cost of equity. Since Chevron is paying its stockholders funds in form of dividends, the dividend growth rate of has a growth rate of 3.81%. The amount of dividends paid in 2020 was 1.29 billion, and in 2015 it was 1.07 billion, as from Yahoo. The period of the dividend calculation is a 5-year period. The cost of equity using this method is 4.92%. This is lower than the cost of equity using the CAMP model. Okay, the bond yield risk plus risk premium. The bond is also used to estimate the cost of equity using the formula below. This is calculated by adding the rate of return on long-term debts and the risk premium. From the analysis above, the risk premium, the bond risk premium, the cost of equity is 2.23% plus 2.25%, which equals 4.48%. Capital structure in WACC. The capital structure is the proportion of preference share capital. The buncher equity share capital retains earnings and long-term debt, and the total sum of the capital that the firm is to raise to run its operations. A firm needs to have sound capital structure so as to maximize shareholders' wealth as this would maximize overall overall cost of capital. We estimate that the capital structure using the weights, the book value, and the market value weights. The average cost of capital is commonly referred to as the company cost of capital. WACC is the average rate that the firm is expected to pay all security holders to fund its assets. WACC takes into accounts all relative weights of every component of capital structure. The following formula is used to compute WACC based on the computations in Excel. WACC of Chevron Corporation is 6.82%. When we compute the weight of cost of capital using the book value of debt and equity are 23,691,000 plus in 144,213,000. WACC equals WEKE plus WDKD. where KD is the cost of debt and KE is the cost of equity, and WD and WE is the weights of debt of equity, respectively. Based on the computations done, the rate of WACC computed using the market value. The market value of debt is 30.68 billion, and the equity and that of equity was 228.37 billion. This market value are found in the New York Stock Exchange where the company trades. The book value weights of debt are higher than the book value weight. No, the market value weight of debt. Looking at the weights of equity, it is noted that the weight that is computed from the market value is higher than what is computed from the book value. Therefore, this implies that the Chevron Corporation stock is overvalued. Next, I'll discuss the cash flow estimates. Forecasting costs and revenues that is associated with a certain project is very difficult. Therefore, large forecasting errors can occur. The basis was 10%, and the amount for the first year was 17,500,000. The 11th year, as per the schedule, is 5,780,000, which was a depreciation rate of 3.3%. The depreciation rate has not been consistent over the 11 years. The new project data is shown below, with a fixed asset of 160 million, salvage value of 60 million, installation of subscription fee is 15 million, total initial investment 175 million. Okay, first year sales a million, expected growth rate was 7%. Sales price per unit 220, inflation rate 3%. The first year variable cost per unit 104. The life of the project was 11 years. Fixed assets life 10 years. WACC 6.88. Okay, the bracket was 40%, and the NOWC scale was 10%. Looking at the cash flow estimates in the Excel file, we see that the after-tax profit has been increasing throughout the period, and shows that the project can maintain a sustainable cash balance, as we can see, despite the cash flow of Chevron is still generating more cash inflows to cater for its expenses. Tax is also increasing year after year, and this shows that the tax obligations of the firm is increasing. The cash flow timeline has been drawn in Excel, and is shown the net cash flows of the project. Okay, capital budgeting analysis. Okay, capital budgeting analysis. In this section, an analysis of the of how Chevron Corporation evaluates capital project has been provided. Capital budgeting is allocation of resources effectively in capital projects, such as its yields, expected return to investors. The two capital budgeting methods employs that employs by the finance evaluates projects include the net present value, the initial rate of return, and the project that is to cost the Chevron the 175 million, and this is exclusive of an initial investment and the amount that is needed to cater for subscription and installations. Capital budget table, net present value is 518,300,000 and 300,000. The IRR is 36.49%. From this analysis on itself, the net profit, the NPV of the company is higher than the initial capital that was invested in the business. This is a positive sign and shows that Chevron investing on a new project would generate more returns, and this is profitable excuse me, for the company, as it is enhance the sustainability in the competitive market. The company is a giant in the oil and gas industry, and investing on the project being beneficial, as it already has a large market share. As per the company capital structure and the revenue generated investing on the new project is a good idea because the initial investment capital is affordable. The company level of leverage is satisfactory, and therefore it is able to pay its creditors in case of liquidation or bankruptcy. The capital structure, which is optimal, I therefore recommend Chevron to go ahead and investing in the project as a return or are worthy, and the initial investments are affordable. However, the company needs to put in some strategies, measurements to ensure that the project is able to generate more return, and the return should be consistent. And thank you. That concludes my presentation.